All right, what's up traders? What's up tycoons? Super excited for today's video. Going to go ahead and do a quick review of the market today, go through some of the different metrics that we look at to analyze the market. We're going to start off here with a seasonality projection. So this is the current S&P 500 and how it's moving. This is the SPY ETF. And then this is the seasonality, performance of what it should look like. And you can see how well it's really been, basically, going in line with this. It's been doing a really good job. It's something that I'm definitely impressed with, from that perspective. If we take a look, we can see here that we're basically in this point here where we should be getting the end of year rally. Now, there's lots of data coming out from here to the rest of the year. We still have more inflation data about to come out. Obviously, we have the situation in Iran escalating at the moment. So, there are risk factors to consider, but we were supposed to get this pullback here in seasonality, right? I mean, the seasonality aligns with this pullback that we've experienced here more recently. All right. And, we're going to see if that will continue to play out, the projection that is the seasonality. And for us to get that end of year rally, and if you take a look, we should break through the highs. So that would put the SPY, above its highs of the year. So that'll be interesting to see how it develops. If we were to go and just take a look at, is the market defensive right now? Right, and how's it looking? There's a few different metrics that I like to look at this. So we have the S&P 500 here on top, and then in blue here we have our high beta stocks relative to our low volatility stocks. We can see that we're getting a nice uptick in here. Okay, before everything was going defensive, it was in a downtrend, and we're starting to establish an uptrend here. In a lot of these, we have consumer discretionary relative to consumer staples here in orange, and we can see discretionaries are outperforming staples. The two aspects that we're really looking for an uptick in is going to be in credit spreads. Okay, and a way that we measure this is through the HYG and the IEI, and also in the biotech sector, XBI. So, right now we basically have about 2 out of 4, okay, saying that, we're trying to go on the offensive here, and that's in our high beta versus low volatility stocks. But, when you take a look at the credit spreads, and when you also take a look at the biotech sector, those are not as bullish. Those are not in as much of an uptrend. So that's where we would be looking for a little bit more of an uptick, to show us that we are much more less defensive. Now, this was an early indicator of some of the drops, all right? And this is basically the Dow theory here. But, what we're looking at, all right, is industrials. So if we were to just take a look at these, we have industrials on top, okay? And then we have the Dow Jones Transportation Average, and then we have the SPX right here. And so what you want to see in this is, we initially had the transportation average breaking down before all of them. Okay, so if we take a look here, we can see basically, right, here's where transportations broke down. They broke down below their yellow support level before the Dow Jones Industrial Average and before the S&P 500. And this was kind of an indicator that, hey, maybe this is potential bad news for the markets. We can see that the Dow Jones Industrial Average followed closely afterwards, as well as the S&P 500. And now all three are in a nice uptrend. The S&P is back up above its major support level here. So we really need to see transportations, and we really need to see the industrials, start to tick back up and get above their major support level. That'll be a sign of confluence and strength in the market. If we were to take a look at the equal weight, so, a lot of people have been saying that, the rally this year has been, pretty much all tech and the Magnificent Seven. Well, if we look at the equal weight on top, this is the NASDAQ equal weight QQQE. All right, it actually did pretty good here today. Okay. And you can see it's very similar to the actual QQQ chart. Of course, QQQ was up 0.71% and QQQE was up about 0.28. So, the big seven still are leading the way. But when you take a look at the NASDAQ equal weight relative to just the NASDAQ, I mean, it's a very similar performance chart, right? So tech was leading the way today. If we take a look at the SPY and the SPY equal weight, we see something very similar. Okay, we have the RSP here up about 0.2%. Meanwhile, the S&P 500 was up about 0.4%. Okay, and so, it's basically just saying that, it's not just the Magnificent Seven right now that's rallying. All right. the RSP got much closer to its lows here, but it is starting to tick back up, and we're also seeing some confluence here in those areas. So, we're starting to see signs that that seasonality projection could be a good thing. And could be a much more possible scenario. When we look at internals for today, though, internals for today did not necessarily justify the move higher, right? So here's, basically we have our CPI report or our PPI report that we got today. It caused an initial drop to the market, right? And during this morning's live stream, I talked about the weakness that we saw in the S&P 500. When you take a look at the internals, right, these were a lot more bullish, right? When we take a look at when you take a look at the advanced decline line, right, we had 2 days of bullishness right here, really about 3 days, all right, in a row, nice uptrend. And what did we do today? Well, we pretty much sold off right until the middle of the day, and that's where the rally came in, right here around 145, and the market rallied to end the day, and that's when we saw internals tick up. But it's a much different look than the trend that we saw right here, the nice uptrend. Same thing with the VOLD, all right. When you take a look at the VOLD was in a very nice uptrend here as well, and performing very nicely. And today it was really flat with a strong push towards the end. So nothing screaming entirely bullish. Like the internals today were not screaming extremely bullish. We didn't really get any extreme readings on the tick today either. So that's basically, what I'm looking at on the internal. So we need to be cautious of, trading into the rest of the week, right? And we're not seeing as much bullishness when we look at some of the other internals. We went over the seasonality. If we were to take a look at our 4 pillars, this is something that's been progressing very nicely here. Okay, so the 4 pillars are pretty important. All right, and the reason that these are my 4 pillars is because you need to see these 4 sectors, performing well. All right, for the broad market, and if you see these 4 sectors performing well, then the broad market overall is going to be performing well. And we talked about how all of these were battling the overhead supply, right? Battling overhead supply, battling overhead supply, battling overhead supply, battling overhead supply. And I mentioned that as soon as we break through these major support levels on any of these or multiple of these, it's going to cause some pain in the market. And where do you see that pain came from? Well, it actually came from the industrials right here and in home builders, right? Home builders is a very important subsector of the industrials, basically. All right. And you can see that home builders are actually recovering, right? In the last video where I went over the 4 pillars, we mentioned that we need to see the home builders and the industrials get back above their major support level. Now, home builders are leading the way for the industrials and trying to do so. It's still early in the week, and we have a very strong weekly body candlestick here on both of those. And I mentioned how, tech was looking very strong, right? I mean, it basically looks like a giant cup and handle forming right here. Also with SMH, this is your semiconductors, a very important part of the, subsector of the tech industry, tech sector. And both of those still look very bullish, both of them on the verge of breaking a shorter term trend line, right? If we were to just draw a simple trend line here, we have another trend line right here. Both of those are very close to potentially breaking out of a cup and handle, being that these are weekly charts that could send us rallying up higher into the end of the year, right? And that would also support that end of year rally, that we're looking for. But we want to see industrials, and we want to see the home builders. We want to see the XLI and the XHB really start to catch up here and participate as well. Okay, we're going to need that for the broader market to get its rally, not just tech. Now, when we come here and we take a look at the percentage of stocks above their 50-day moving average, as well as the percentage of stocks above their 200-day moving average, we've seen some nice developments here. Okay, now there's still some things that need to happen. I'll basically break down what those things are that we need to see happen. But there was an important buy signal that we had recently when it comes to the percentage of stocks trading above their 50-day moving average. These little shaded areas here in these boxes, these are buy zones, right? And pretty much any time that we've come down into these zones and into these areas, we've seen some pretty significant moves in the stock market, right? And that's pretty much what we see, right? If we kind of align all of these, you can see where the percentage of stocks trading above their 50-day moving average, it fell below 10% here, which is an extremely bearish reading, and extremely, really, really bearish reading. And we're seeing a strong rebound, right? And then very shortly afterwards, we saw that very strong rebound in the S&P 500 from the lows. The S&P 500 has rallied almost 4%, okay, about 3.6%. And this is a buy signal, right? If we were to zoom out on these, okay, for you guys, so you can see real quick, each time that we've come down into these levels, right? So you can see in October, of 2022, right, when the S&P ended up bottoming, we came down into those extreme oversold readings on the percentage of stocks above their 200-day moving average. We also reached that right here on the percentage of stocks above their 50-day moving average. You can see during the COVID crash as well, right? Of course, there were barely any stocks trading above their 250-day moving averages at that time period. That was also a bottoming signal. Same thing over here back in this is like October of 2019, or maybe 2018. All right, December 2018. We see the same thing where we're back in these extreme oversold conditions where a very small percentage of stocks, less than 10% are trading above their 50-day moving average, and then less than 20% are trading above their 200-day moving average. Oftentimes those are good, bottoming signals and times to, start looking at some long positions for some longer term trades, whether they're, longer term swing trades or just some overall long-term investment decisions. Those are good areas, and we came back into that zone. We came back into that region here recently, as I highlighted, on the percentage of stocks above their 50-day moving average. These blue and these green lines, these are some things that I look at for bullish and bearish indicators. Okay, and we're very close to getting the green line crossing above the blue line here on the percentage of stocks trading above their 50-day moving average. That's going to be a pretty bullish signal. Okay, you can see when we initially crossed down, it was back here in the beginning of August. And you can see August 1st, just before August 1st was really the high of the year for the S&P 500. And then ever since then, we started trading bearish, right? And that's when we got our signal here. Our bearish signal was on August 1st. For the percentage of stocks above their 50-day moving average, and also for the percentage of stocks above their 200-day moving average. So the percentage of stocks above their 50-day moving average is trying to get that bullish crossover on our indicators here. We're going to look to see if we can get that followed by the percentage of stocks trading above their 200-day moving average. And those are going to be some good signs for the market, in my opinion. And we'll have to see how those progress if we can continue to get those. See if there's anything else that I want to go over with you guys really quickly. When we talk about TLT and the S&P 500, I've mentioned, a couple times about the divergences and how you can look to play these divergences to spot, some potential, opportunities. And so what we had essentially was TLT was continuing to make these lower highs. TLT can oftentimes be a leading indicator for the S&P. So we're making lower highs in a downtrend here while the S&P is making higher highs. That's an indicator that, being that TLT is a leading indicator that, hey, maybe the S&P should drop, right? And if, sure enough, we end up getting that drop. Same thing over here. We're continuing to make these higher highs while TLT is continuing to make these lower highs, indicating we should see a drop in the stock market. And most recently, we had a divergence again where we were creating lower highs while the S&P was creating higher highs, and we broke through there. And now these two are trading a little bit in confluence at the moment. So there's no major divergences between these two. We'll have to monitor that and stay, paying attention to that in the future, and see how that progresses and see if we can spot any, signals that TLT can give us being a leading indicator for the S&P 500. Now, that pretty much wraps up today's video. Hopefully you guys enjoyed it. If you did, smash that like button, subscribe to the channel for more, and I'm out.